Hello, everybody. This is Eugene with Signet Financial Management. I would like to update everybody with the stock market situation. And today we will talk about multiple things. First, please take a look at our disclosures and disclaimer. So today we will talk about the overall state of U.S. equities. I will update you on size and style. We will take a look at our multi-factor macro sector forecast. And I will also speak about the conference board coincidence indicator. We'll talk about factor groups and how they behave throughout business cycle. We will also I will introduce you to MacroAware MicroScore we recently developed, and we will take a look at what factors worked recently and what factors didn't. We will also look at our individual equity portfolios, which are actively managed by us, and I will speak about changes we've recently made to our strategic all equity portfolio and strategic dividend equity portfolios. And finally, I will kind of briefly introduce our still in development, but pretty cool product called Signet Equity Portfolio Analyzer. So with regards to the overall state of the global economy, we saw in the first quarter that the synchronized uprising got broken a little bit, with developed markets slowing down. A lot of participants in the marketplace believe it's a temporary slowdown and the growth should resume in the second half of 2018. Markets seem wary of trade wars and geopolitical uncertainties. So when there are things like the very recent one in Italy erupt, they do influence the markets in the short run. And we saw that in the last couple months, actually, with more the higher risks of trade wars and this, the global economy slowing down a little bit. It did influence the markets. Those things did influence the markets. We still believe the environment remains pretty supportive for U.S. equities in the long run. We see earnings and sales at the highest in years. We see inflation still in check and at the Federal Reserve target. The full employment has been achieved. There is some room to grow, and the consensus is that the low participation rate provides the necessary buffer for the economy to grow before constraints kick in, with a full force. And obviously, we just experienced and saw the market underreaction to earnings because of those, global affairs. And that actually made valuations back home very attractive. So on style update, we are, we've gone through a pretty strong growth cycle. And at the moment, I think we are at the neutral state. We are moving towards value, but we're not there yet. So at this juncture, we are positioning ourselves more as the neutral. On the size update, as we all know, this year small caps have been outperforming large caps, and on a 3-year moving average, they do as well. So we take a note of that. Obviously, all those things, the broad and the potential of the trade war influence things, and that's why small caps actually look a little more favorably at this point, because those businesses are much more domestic oriented, and less, susceptible to those geopolitical risks. If you look at the shape of yield curve and credit spreads, there's still, credit spreads at the historical lows, and yield curve, obviously the short end has been going up because Federal Reserve has been raising interest rates, but the long side started going up as well. So you can see there is a flake of yield curve actually going up. As from the classic economic theory, if the yield curve is actually steepening, the market anticipates more growth down the road. So from our multi-factor macroeconomic forecast, our forecast looks at a whole bunch of macro indicators, the market, the stock and the bond market. And at this juncture, the reading is actually pretty defensive. So we have positive views on staples, healthcare, real estate, telecom, and utilities. All classic, staples, healthcare, telecom, and utilities are the four classic, safety nets in the marketplace. We're neutral or slightly negative in consumer discretionary, financials, and technology, but it's more of neutral stance. And the readings are actually negative for energy, industrials, and materials. And this slide pretty much shows that that's the direction. Our ratings have been changing, so pretty much the same thing. When you look at this chart, which shows month by month the progression of the next 12 months forecast for each individual economic sector, you can see that we've got glimpses of hope here with consumer discretionary turning green. We still, consumer staples are still kind of expensive. We still see some room for this economic cycle to continue, but you can see that, closer to the end of this year, the forecast becomes even more defensive with consumer staples and utilities becoming, pretty green here. Overall, it doesn't necessarily mean that we're going to have a recession in October or starting October of this year. What it does show, though, that the market is going to continue being pretty volatile over the next few months. At this juncture, we still favor GARP indicators, and I'll talk more about this. We like what we see in corporate earnings, and we understand that the market underestimated or underreacted, I should say, to great earnings season. And as I said before, we believe global economic expansion should resume in the second half of this year. We work a lot with factors, and one of the things we introduced recently is a macro aware score, which actually not rotates, but overweights, overemphasizes, or underemphasizes different factor groups because of the state of the economy and our macro forecast. What I show here is the JP Morgan's presentation of Conference Board's Economic Confidence Index. And this indicator actually takes a look at the existing state of the economy. It's not a leading indicator. It's a coincident indicator. So it actually shows where we are at point in time in the economic business cycle. And as you can see, obviously 2008 was a big contraction. We do have different economic cycles, right? The stages of business cycles: slowdown, expansion, recovery, contraction. So we go first. We go through recovery, expansion, slowdown, contraction, and then the business cycle resumes. What's interesting, 2015, 2016, we did see slowdown and contraction. So, and I will actually show later that our score actually reflects those things. So this is another great demonstration by J.P. Morgan. They recently published a pretty extensive U.S. factor reference book, and I'm including this chart which shows how different factor groups behave in different stages of business cycle. So, for example, in slowdown, you want to overweight growth, quality, and momentum. In contraction, you overweight value, you neutral growth, and you overweight quality. Momentum actually is at a huge disadvantage when we're in contraction because the investment regime shifts. When we are actually on the recovery road, you overweight value. There is at the end of contraction, early recovery, there is a fresh flight. Usually companies with pretty bad fundamentals take off because all of a sudden people realize the sky is blue. And so you underweight actually quality and you neutral momentum, and you prefer higher volatility stocks over low volatility stocks. And during the expansion, expansion usually is the longest of the four stages. You overweight value, neutral growth, neutral quality, and obviously one of the strongest factors during expansion is momentum. So this heat map actually represents our newly developed macro score. It's not necessarily totally newly developed. We took all the ingredients of our score, our traditional score we still use very much, but we grouped those underlying factors, which are macro scores composed of, into separate groups. We have value subgroup, profitability subgroup, growth subgroup, yield subgroup, momentum, and safety. And you can see that throughout the quarters, we try to, those quarters are non-conventional because we wanted to capture the end of April of this year. But nevertheless, you can see that our macro score does have some moments when it gets flipped. So what we'll look here, we'll look at the difference of performance of the first quintile of our 3,500 stock universe, except we exclude all the microcaps from there. And we take the first 20% of companies and we compare those, the best of the best, the performance of the best, to the average of the universe. As you can see, for the most part, the score is working, but I would like to point out that, for example, in 2009, when we were getting out of Great Recession, you can see that momentum was a horrible factor to follow, and so was safety. But then going into recession and staying in the recession, you can see that safety was the best performing factors. So just as we go through the cycle, like we saw here, there are different groups of factors and they behave differently in different stages. Overall, it's normal to have your macro score, your score really rotate. Sometimes it's a normal process of a quantitative method. all in all, even when some of the subgroups underperform, we still have our score being uh, less impacted because it contains all the subgroups. Recently, in 2015, 2016, remember I showed you there was a contraction by the coincidence indicator, and that actually gets reflected here. We saw safety again was the only predominant factor in, and people and investors got very risk averse during that time. So our score, which has still a very big representation of value, growth, GARP, underperforms during those panic attacks. But that's normal. It does get repaired, and we get advantages at the time when the market calms down a little bit. So recently, in the last 2 months, actually, the market again became pretty afraid of trade wars, geopolitical tensions, and a risk aversion was on again. So you can see that safety turned green again. Some of the momentum of the companies with greatest safety features prevailed, and the framework of GARP, value and growth, underperformed. And we saw it across the board in our portfolios as well. Again, it's normal, it's cyclical. We just have to live through it, and we have to manage the risk. And we do manage the risk, but we don't want to pay for a risk aversion with with the bets which are too expensive. We're trying to manage more risk for our clients through allocations. So with all this chart shows the cumulative performance of our best quantile of macro score versus the average of the universe. And as you can see, as we go through the business cycle, it does pay off to stay long our best score. There are some, as I said, circumstances when the market tries to predict recession, and you see that in 2015, 2016, we went a little steeper than the average. The same happened recently, but that's normal. As we go through the cycle, we still create traction. So recently, when we look at our portfolios and what worked and what didn't, we can see that we didn't have that many contributors to the overall performance. I mean, all the contributors are the sectors we either underweighted or, with just a speck of, good results in real estate. The majority of sectors we underperformed because our scores, as I demonstrated earlier, got flipped. Again, it's normal, it's cyclical, and we expect this to reverse. We did make some changes in our strategic all equity portfolio because of the continuous notion of small and mid caps outperforming. We started tilting towards mid and small caps. And we're still following the pretty much neutral posture with some emphasis on GARP. We still believe that going safety right now is a little more expensive. Utilities are very overvalued, and consumer staples have gone down quite a bit at much more reasonable valuations. So we're still looking at consumer staples over the next few quarters to be added to the portfolio. But at this juncture, we believe it's a little premature. So sector-wise, we still overweight technology, but we reduced the overweight. It's very interesting. The market really stopped paying attention to free cash flow during those phases. And I do want to, again, kind of come back to this slide. And free cash flow is one of the most consistent factors throughout the business cycle. And in the last 2 months, the market pretty much disregards free cash flow, which is embedded in a lot of the subgroups of our scores. And that's a short-term noise, which usually doesn't have long-term legs. And that's why we truly believe that the trend's going to get reversed here. So technology-wise, technology companies still produce the vast majority of free cash flow among economic sectors. We reduced them a little bit, but we're still overweight technology. We're closing gap in consumer discretionary because of that hope we see, full employment, people making money, there's wage inflation, and the consumption is on the rise. And we closed the gap in healthcare as well. And as I mentioned, we're watching staples. So these are the sells and the buys in the portfolios. As you can see, our strategic equity portfolio is pretty well diversified. We still very healthy represented in information technology, financials, healthcare, consumer discretionary. So we are not that far away from the composite benchmark. With regards to size and style, this is our Morningstar classification. You can see that we are still slightly tilted towards growth, but the blend, which is more of a GARP indicator, we're at 46%. Sorry. So we have very much emphasized GARP posturing. And with large and medium and small cap, we're at 62% large cap and 37% small and mid cap, which is a pretty healthy representation in the smaller capitalization of the marketplace. With regards to our strategic dividend equity portfolio, we maintain our large cap posturing. The portfolio is by nature value oriented. And what we did in this rebalancing, we closed gaps on consumer discretionary, still slightly overweight in telecom and real estate. And these are the sells and the buys in the portfolio. Again, the portfolio is pretty well diversified. Financials obviously occupies a larger portion of the portfolio because they pay dividends. Information technology is pretty well represented, and so are healthcare and consumer discretionaries. This portfolio is much more value oriented and much more large oriented. So recently we've developed a pretty cool tool which allows us to upload the portfolio and get a snapshot with regards to our scores, where the portfolio stands, which stock, sector, size, and style. I emphasize at this juncture, this instrument still is in development, but at some point we believe we'll be able to introduce it to a broader public. So stay tuned. We're very excited about it. And if not opened up to the broader public, we still have our internal staff. We have them access the tool, and actually they can help you reviewing some of your ideas even when you work with them. So that concludes my presentation for today. If you have any questions, please don't hesitate to reach out. I'm reachable at the email or by phone. And thank you so much. This was Eugene Yashin with Signet Financial Management.